Most people think investing is only for the rich. They imagine that you need thousands of dollars before you can even begin. Because of this belief, millions of people spend years waiting for the perfect moment to start investing. But the truth is very different. Today, investing is more accessible than ever before. You can start building wealth with as little as $100. In fact, learning how to invest a small amount correctly can be more valuable than having thousands of dollars with no plan. In this video, you'll learn exactly how to invest your first $100 and take the first step toward financial freedom. The biggest investing mistake is not choosing the wrong stock. The biggest mistake is waiting too long to start. Every year you delay investing is a year your money loses the chance to grow. Many people tell themselves they will invest when they earn more money, but that day often never comes. Wealth is usually built through consistency, not large amounts of money. Starting with $100 today can be far more powerful than waiting years to invest $1,000 later. Time is the secret weapon of every successful investor, and the sooner you begin, the greater your advantage becomes. Before investing, it's important to understand the difference between saving and investing. Saving protects your money, while investing grows your money. A savings account is useful for emergencies and short-term goals, but it usually provides very low returns. Investing allows your money to work for you by owning assets that can increase in value over time. The problem is that many people save forever but never invest. As inflation rises, the purchasing power of their money slowly decreases. This is why building wealth requires more than simply saving. It requires owning assets that can grow faster than inflation. So what exactly is investing? Investing means using your money to buy assets that have the potential to grow in value over time. When you buy stocks, you own a small piece of a company. When you buy ETFs, you own small pieces of many companies at once. When you buy real estate, you own property that may appreciate and generate income. Investing is not gambling when done correctly. It is the process of putting your money into productive assets that create value and wealth over the long term. When you buy a stock, you're buying a small piece of a real company. If that company grows, your investment can grow as well. Imagine owning a tiny piece of companies like Apple, Microsoft, or Amazon. As these businesses generate profits and increase in value, shareholders can benefit from that growth. Many beginners believe they need thousands of dollars to buy stocks, but that's no longer true. Modern investing platforms allow you to buy fractional shares, meaning even $100 can be enough to start building ownership in some of the world's most successful businesses. While individual stocks can be powerful investments, they also carry risk. That's why many beginners choose ETFs instead. ETF stands for Exchange Traded Fund. Think of an ETF as a basket containing dozens, hundreds, or even thousands of different companies. Instead of betting on one company, you're spreading your investment across many businesses at the same time. This diversification reduces risk and makes ETFs one of the most beginner-friendly investment tools available. For most new investors, ETFs provide a simple way to participate in long-term market growth without constantly researching individual stocks. If you only have $100, an ETF is often one of the smartest places to begin. Instead of relying on the success of a single company, you're investing in an entire collection of businesses. Many popular ETFs track major stock indexes like the S&P 500, which includes some of the largest companies in America. Historically, these broad market funds have produced strong long-term returns. While no investment is guaranteed, ETFs help beginners avoid one of the biggest mistakes in investing, putting all their money into a single stock and hoping for the best. Now let's talk about the most powerful force in investing, compound growth. Compounding happens when your investment generates returns, and those returns begin generating returns of their own. Over time, this creates a snowball effect that can dramatically increase your wealth. The earlier you start investing, the more time compounding has to work for you. This is why even a small investment today can become surprisingly valuable in the future. Wealth is rarely built overnight. Instead, it's often built through years of consistent investing and allowing compound growth to do the heavy lifting. Every investment comes with risk. The goal isn't to avoid risk completely. The goal is to understand it and manage it wisely. Generally speaking, investments with higher potential returns often carry higher levels of risk. Keeping money under your mattress may feel safe, but inflation slowly reduces its value. On the other hand, investing in stocks and ETFs involves short-term ups and downs but offers the potential for long-term growth. Successful investors don't panic during market declines. They focus on the bigger picture. Understanding risk is one of the most important skills you can develop because wealth is built by managing risk, not avoiding it. So what should you do with your first $100? For most beginners, the simplest approach is investing in a broad market ETF. This provides instant diversification and exposure to hundreds of companies with a single purchase. Instead of trying to predict the next winning stock, you focus on participating in the overall growth of the market. The goal isn't to get rich overnight. The goal is to build good investing habits. Your first $100 is not about making a fortune. It's about learning the process and creating momentum for your future wealth-building journey. A beginner portfolio doesn't need to be complicated. In fact, simplicity is often the smartest strategy. Many successful investors build wealth using only one or two broad market ETFs. The more complicated your portfolio becomes, the harder it is to manage and understand. Your focus should be on consistency rather than complexity. A simple portfolio allows you to stay invested through market ups and downs without constantly making emotional decisions. Remember, successful investing is not about finding the perfect investment. It's about sticking with a solid plan for a very long time. Many beginners make the same investing mistakes. They chase hot stocks, panic during market declines, or try to get rich quickly. Others constantly buy and sell investments based on emotions instead of logic. These behaviors often hurt long-term performance. The truth is that investing rewards patience more than excitement. Successful investors focus on consistency, discipline, and long-term thinking. Avoiding common mistakes can be just as important as choosing the right investments. Sometimes the best investing decision is simply staying calm and continuing to invest when everyone else is reacting emotionally. One of the easiest ways to invest successfully is through a strategy called dollar-cost averaging. Instead of trying to predict the perfect time to invest, you invest a fixed amount regularly. For example, you could invest $50 every month into a broad market ETF. Some months the market will be higher. Some months it will be lower. But over time, this strategy helps reduce emotional decisions and keeps you consistently building wealth. Dollar-cost averaging removes the pressure of timing the market and replaces it with a simple habit. For beginners, consistency often beats trying to be clever. Let's build a simple first investment plan. Step 1. Open a reputable brokerage account. Step 2. Deposit your first $100. Step 3. Choose a broad market ETF. Step 4. Set up automatic monthly investing. And Step 5. Stay invested for the long term. That's it. No complicated strategies. No constant trading. No chasing the next hot stock. Investing is surprisingly simple when you focus on the fundamentals. The real challenge isn't understanding investing. The real challenge is having the patience to stick with your plan year after year while your wealth quietly grows in the background. Your first $100 will probably not make you rich, but it can change the direction of your financial future. Every successful investor started somewhere. The difference is that they took action while others continued waiting. Investing is not about getting rich quickly. It's about building habits that create wealth over decades. The best time to start investing was years ago. The second best time is today. So take that first step, invest your first $100, and begin your journey toward financial freedom. If you enjoyed this video, subscribe for more finance documentaries that simplify money, investing, and wealth creation.